Welcome to Breaking News, to Trading Moves. Today we are tackling a question that, frankly, every trader has to face. What if that sinking feeling in your stomach right before you execute a trade isn't a warning sign to stop, but actually the mathematical footprint of your best opportunity?
Right. It's a feeling we all know entirely too well. Exactly. If you are listening to this and you have ever stared at a chart waiting for that perfectly clean breakout, well, you know exactly what happens next. By the time you feel safe to enter, the move is already half over. So today, we are examining the precise role of emotional discomfort when executing trades. We are looking at the tension between acting during periods of maximum uncertainty versus waiting for the comfort of confirmation. I take the stance that a trader's true edge comes primarily from executing early. Precisely when a trade feels messy, uncertain, and distinctly uncomfortable, that is where you find the primary driver of capturing a favorable risk-to-reward ratio. You just have to act before the crowd feels safe.
Yeah, and I approach this from a completely different angle. I am going to argue that emotional discomfort is a highly unreliable metric. I mean, it can very easily mask reckless, impulsive behavior under the guise of being contrarian. True edge comes solely from a predefined process and strict risk parameters, not from chasing a feeling of unease.
Let's lay out the mechanics of why the math demands early action. Markets do not reward certainty. They reward good decisions made under conditions of uncertainty. If you wait for a pristine, clean chart or, for universal agreement among market participants, you are waiting too long.
Well, sure, but
Let me just give a concrete example real quick. Suppose an asset is pulling back to a major support zone at $100. Your technical invalidation level, the exact price where your thesis is proven mathematically wrong, is $98. If you buy right at 100, while the asset is actively dropping and the chart looks terrifying, your defined risk is exactly $2. But what happens if you wait for confirmation?
you wait for a bullish candle to close or a moving average to cross.
Exactly. You wait for visual proof. So the asset bounces to $104. Now you feel safe. The chart looks green, the momentum is upward, but your structural invalidation level hasn't moved. It is still $98.
Right. The stop is the same.
Yeah. So by waiting for the psychological comfort of that late entry, your risk has just jumped from $2 to $6. Your potential reward is smaller because the price is already higher, and your risk is triple. You have to reduce your position size to compensate, which means your upside is severely capped. The comfort literally destroys the mathematical edge of the strategy. It is like buying fire insurance while the house is already on fire. The price already reflects the obvious reality. Discomfort is just the premium you pay for a superior entry price.
Okay, I don't disagree with the basic arithmetic of risk and reward there. Late entries absolutely worsen the numbers. But we really must address the behavioral trap you were setting up here.
Trap? How is it a trap if it's math?
Because rushing into a position purely to avoid missing a move, or worse, buying a collapsing asset just because it feels bad isn't an edge. It is a death wish. The fear of missing out constantly masquerades as embracing uncertainty.
But fear
Let me just finish this thought. Fear serves a vital protective purpose in trading. It prevents oversizing your positions, it stops you from chasing price, and it keeps you from entering without a meticulously defined plan. Fear should prompt a careful, methodical review of the setup. It is a warning system, not an automatic green light to blindly execute.
I will admit, even knowing this exact math, when I see a massive red candle crashing through a support level, my brain absolutely screams at me to wait. My hand physically hesitates on the mouse.
As it should.
But it takes immense cognitive override to hit the buy button in that specific split second. How is a retail trader supposed to just ignore that biological response? We are wired to avoid pain.
They don't ignore it. They contextualize it. But if you are flying by the seat of your pants, that adrenaline will ruin you. This is why you cannot use your internal emotional state as a primary indicator. You are conflating the environment of the trade with the validity of the trade.
What do you mean by that exactly?
I mean, a trade can feel uncomfortable and be valid, yes, but it can also feel uncomfortable because it is a terrible idea and you are about to lose a substantial amount of capital. Before entering any position, you have to ask yourself the core questions. Is the setup following rules? Is the stop clear? Is the reward worth the risk? Without answering these clearly, discomfort is merely a reason to freeze.
But let's break down exactly why the chart looks so ugly in that moment. Why does the price action violently oscillate? It comes down to the mechanics of liquidity in the order book. For institutional algorithms to accumulate a massive position at a favorable price, they require sellers.
Right, they need liquidity.
Exactly. So how do they get it? They allow the price to drop rapidly into a support zone, triggering a cascade of retail stop losses. Retail traders sell out of panic, hitting the bid with aggressive market orders. And who is buying?
The smart money.
Yes, sitting right there with passive limit orders, absorbing the panic. So the optimal entry point, the very bottom of that pullback, is structurally designed to look as terrifying as possible. The speed of the tape is incredibly fast. The red candles are large. If you want to get the exact same fill as the institutional algorithms, you have to buy the exact same panic they are buying.
That is an accurate description of order flow. Institutions buy into weakness and sell into strength.
Right. Think of the market right before a major directional movement, like a coiled spring. The ugliest moments on the chart are when that spring is compressed to its absolute maximum tension by opposing forces. You have aggressive retail sellers slamming the bid and passive institutional buyers absorbing every share. Entering the market in that exact second feels dangerous because you can physically see the pressure on your screen. But that extreme pressure is exactly what provides the kinetic energy for the resulting move. If you wait until the spring is fully uncoiled to confirm it's safe, the kinetic energy is already spent. You missed the trade.
Well, a coiled spring is a vivid metaphor, but I have to stop you there. If you step in front of a freight train thinking it is a spring, you are going to get flattened.
That's a fair warning.
You are describing the mechanics of liquidity, which is factual. However, you are prescribing a behavioral response that is incredibly dangerous. A trader feeling terror does not mean smart money is accumulating. A trader feeling terror often means the trend has broken and the asset is heading much lower. Rushing to catch a falling knife often means you are stepping right into heavy institutional distribution. This is why we must separate emotional discomfort from actual trade danger. You cannot just rely on your gut telling you it feels suitably uncomfortable.
So how do you practically filter that in real time? Because checking a list of abstract rules while the tape is flying seems impossible. The cognitive load of answering a 5-point checklist while your screen is flashing red is too heavy for a human brain under stress.
You don't use a generic checklist. You upgrade the questions you ask yourself. Instead of abstract rules, you focus on the mechanics of your own perception. In that moment of panic, the only question that truly matters is, am I reacting to the structure of the market or the speed of the tape?
That is a crucial distinction. Let's connect the dots for the listener here. What is the actual difference in live execution?
The structure of the market is objective. It is the math. It is the fact that the price is exactly at your predefined support zone and your stop loss is placed in a logical location where your thesis is invalidated.
Okay.
Stream. When you feel the overwhelming urge to freeze or to abort the plan, you ask yourself, has the actual market structure broken or is the tape just moving really fast? If the structure is intact, the trade remains valid regardless of the visual violence. Without making that distinction, the discomfort just paralyzes you.
I see the logic in separating structure from speed, but let's be realistic about live execution here. Markets actively manufacture doubt right before a major directional movement. If there were no doubt, there would be no opportunity.
True, but
Wait, let's say a trader is looking to buy that pullback we discussed. The price starts dropping sharply toward their predefined entry zone. As it approaches, the immediate momentum looks terrible. The trader's rules say buy, but their eyes see a collapsing asset. In that exact fraction of a second, asking whether the structure is intact becomes distorted by the visual violence of the price action. The hesitation is natural.
Which is exactly why the rules for market structure must be binary. They cannot be subjective. Did the price touch the predefined level or not? Is the longer-term trend intact or not? The subjective interpretation of visual violence is exactly the emotional noise my framework is designed to filter out. An experienced professional knows what that discomfort means strictly inside their process. They have predefined invalidation levels that they accept before the capital is ever at risk.
But if the discomfort forces you to pause and run this mental diagnostic, right as the price hits the optimal entry zone, you introduce a delay. That hesitation is exactly how the best entries are missed. While you are verifying that the structure is intact and managing your psychology, the asset bounces. The institutional algorithms don't hesitate. Their limit orders just execute. Now, because you pause to seek cognitive clarity, your stop is further away, your risk to reward is diminished, and you are left chasing the price with a market order. You suffer slippage. The attempt to be procedurally perfect costs you the execution.
A delayed entry that results in a missed trade is infinitely preferable to an impulsive entry that results in a catastrophic loss.
Is it, though?
Absolutely. Missing a trade preserves your capital. Entering a bad trade destroys it. If your process takes an extra 3 seconds to verify and you miss the absolute tick-perfect bottom, that is simply the cost of doing business safely.
I would frame that cost differently, honestly. The cost of doing business safely often means slowly bleeding your account through mediocre risk-to-reward entries. If you consistently enter late because you needed cognitive comfort or because you took too long to analyze the speed of the tape, your winners are smaller, your losers are larger relative to your entry price. You are systematically degrading your mathematical expectancy. Over 100 trades, that slow bleed is just as destructive as a single massive loss.
And you're suggesting traders should leap into the dark purely because the darkness offers a better theoretical price. That is a swift path to ruin.
Not blindly leap.
The goal is not to remove discomfort, as we established. The goal is to plan the entries in advance so the cognitive load during execution is minimized. You define the structure before the market opens. You place your limit orders ahead of time. You accept the possibility of a small loss before the capital is ever committed. That is how you bypass the speed of the tape.
I concede that planning in advance is critical. Using passive limit orders rather than aggressive market orders certainly removes some of the emotional friction. But even with the most meticulous plan, the moment the capital is at risk, the market will present new, conflicting information. A sudden spike in volume, a correlated asset dropping, a headline hitting the wire. Markets create doubt before movement. If there were no doubt, there would be no edge. The discomfort is part of the trade. It is not an anomaly to be filtered out. It is the core environment where profit is extracted.
We both agree that the market environment is inherently uncertain, but the response to that uncertainty defines the trader. Reviewing whether uncomfortable trades are actually part of your edge requires objective data collection, not just remembering how you felt. When you review your journal, you do not measure the intensity of your fear. You measure the adherence to your structural rules.
Yet, if you look closely at a comprehensive journal of highly successful trades, a consistent pattern almost always emerges. The entries that yielded the largest multiple of return were precisely the ones that felt the most terrifying at the exact moment of execution. The charts looked messy, the prevailing trend felt questionable, the broader crowd was looking the opposite direction. The physical discomfort was the leading indicator of the resulting outperformance.
Wait, I have to challenge that conclusion directly.
Go ahead.
What you are describing is textbook survivorship bias. You remember the terrifying trades that worked out because the emotional relief and the dopamine rush of a massive win are incredibly potent. It cements the event in your psychology. But you conveniently forget the 20 other times you felt terrified, stepped in front of a falling knife, and watched your count evaporate in seconds. You don't remember those because your brain suppresses the pain of the catastrophic loss. This is exactly why relying on the sensation of discomfort is a trap. It prevents the subjective memory of past trades from dictating future capital allocation.
Well, I will admit that survivorship bias plays a substantial role in how we remember our performance. The dopamine hit of a contrarian win is powerful. However, if we look purely at market mechanics, the point of maximum financial opportunity mathematically coincides with the point of maximum visual ugliness on a chart. To capture the former, you must execute during the latter. The discomfort might not be the edge itself, but it is the unavoidable toll you pay to access the edge.
You can execute during the visual ugliness, provided the structural risk parameters are fully intact. The visual ugliness does not exempt you from strict risk management. That is my central thesis. You don't buy the ugliness just because it is ugly. You buy it because your predefined parameters tell you the structure holds up despite the visual panic.
So, despite our different frameworks, we have found major areas of convergence today. We both firmly agree that waiting for perfect confirmation is a trap. The desire for a clean, comfortable chart often damages the risk-to-reward ratio irreparably, forcing traders to take wider stops and smaller position sizes.
Yes, we definitely agree on that. And we also agree that feeling completely comfortable in a trade is not a reliable indicator of its quality. Total comfort is often a glaring sign that you are late to the movement and the optimal entry is passed. Discomfort should trigger a rigorous review of the setup, specifically separating market structure from the speed of the tape, rather than an automatic avoidance of the trade.
Precisely. We both agree you should not blindly jump into the market just because things look chaotic.
Exactly. You need to know the specific mechanics of your strategy, the exact location of your invalidation levels, and you must trust your predefined process above your emotional impulses.
But you also cannot sit on the sidelines forever, waiting for a perfectly clear signal, because the market prices in the obvious information immediately. The opportunity exists in the messy transition between panic and resolution.
A compelling place to leave the analysis.
Listeners, evaluate your own relationship with the discomfort of execution. When you review your past performance, analyze whether your most uncomfortable trades are actually the foundational elements of your edge, or just moments of poor discipline. Look closely at whether you are reacting to the structure of the market or the speed of the tape. There is much more to explore regarding emotional management and execution mechanics in the markets. We leave you to form your own conclusions. Until next time.